People always want help when the market sells off. They want me to tell them what to do, to validate their fears. When stocks get hammered, investors freak out. They panic, or at least they want to panic. I think that's right. I mean, I obviously don't want you to panic, but that's what people are doing. Many don't know what's going wrong. Few can easily handle the trauma of big losses. And even the smartest operators want some expert advice. But after more than 4 decades in this industry, I can't recall a single time when someone's come up to me and plaintively asked, Jim, the market's rallying like crazy. What the heck do we do? Hey, that's unfortunate, because just as you need a playbook to deal with declines, like I just mentioned, you also need a rally playbook, a guide that tells you what to do when the market's having a big short-term run. Not sell-off, but run. I know the received wisdom is that nobody wants to help with a rally, but you need to reject that idea that people only need help when the market's lousy. There are all kinds of mistakes you can make when the stocks are going higher. In fact, the rally playbook might be more important than the sell-off playbook, if only because so few people think they need one. So here's my first rule for handling a rally. Always be really, really, really tough on your portfolio, not just on the down days, but on the big up days. The only time you should be harder on the stocks you own is when you're in the midst of a brutal decline with no end in sight and the need to circle the wagons, meaning dump everything you aren't thrilled to own and use the cash to shore up your positions in the stocks where you have the most conviction. Obviously, that's a worst-case scenario. How exactly do you get tough on your portfolio? When you need to give every one of your stocks the harshest possible evaluation. Suspend the benefit of the doubt. Assume everything you own is guilty until proven innocent. Focus on the worst qualities of your stocks. Emphasize the downside. Make each and every company you own prove to you that it's worth holding all over again. If this strikes you as silly or even unfair to your fabulous stocks, allow me to explain, please. On a good day or a good week, you're ready to fall in love with your positions because they made you so much money. That's typical, but it's also a mistake. You can love your spouse, you can love your kids, you can love your pets. I like one of them. You can love your country. You can even love your car, just as long as you don't become enamored with your stocks. Silly pieces of paper that you bought for the sole purpose of making money. They're not going to love you back. In fact, when we're in the midst of a big rally, you really shouldn't give your stocks too much credit for making you money unless they dramatically outperform the rest of the market. Yet even then, you need to give your stocks a hard time. When a stock makes you a fortune, the normal reaction is to like that stock or like it more. However, think about this. Most of the time, you should like it less for the simple reason that stocks get more expensive when they go higher. During a major market-wide rally, unless there's some serious value-enhancing good news, your stocks become pricier and therefore less desirable. If you didn't own them, you know this, right? When you look at it, oh, that stock's up too much. For example, no matter how much you like Microsoft, the company, and I do, Microsoft, the stock, is a lot more attractive, say, at $250 than it is at $350, correct? In other words, in the wake of a big up move, your entire portfolio just got less attractive. Like I constantly explain to members of the CNBC Investing Club, price matters. And when a stock price goes up, the risk-reward becomes worse, okay? Valuation makes it more volatile. You made money, which is what we're after. But you can't let that prejudice you in favor of any particular stock. Just like blackjack, the cards have no memory, people. While your stock may have gone up when the market was roaring, that doesn't have much bearing on where it goes tomorrow, does it? The second reason to get tough on your portfolio during a rally is that you can figure out which ones to sell and sell hard. I tell you to sell in the strength all the time, but I recognize this idea is totally contrary to human nature. In a rally, everyone else is buying like crazy. You feel great about your stocks, and you certainly don't want to sell. But you have to, because there's no better time to sell than during a major short-term move higher. Oh, and by the way, this selling doctrine applies to everything, even mutual funds. If you have gigantic short-term gains, it's okay to ring the register on some of them. I like that. Again, we all know this is true on some level. We know buy low, sell high. But that's hard to execute in the moment. You have to, though, because the facts have borne it out for years. Even as nobody likes being told to sell a winning stock into a smoking hot rally. So how do you fight your instincts? How do you get to a place where you can sell in spite of your emotions? Simple. Just like I said before, you get tough in your portfolio, reevaluate your stocks, and demand a lot more from them than you normally would, especially since they're more expensive than they were the day before because they went up. Now, I've got a very specific way of grading my stocks that I've used since my hedge fund days. Every week, I rank the stocks in my charitable trust, which you can follow along with by joining the CNBC Investing Club, which I urge you to do. I rank them from 1 to 4. Ones are stocks you would buy at their current price. Twos are stocks you'd buy if they pulled back. Threes are stocks you'd sell at a higher price, and fours are stocks, well, let's say you don't want to take any action on without more information, period. And when it comes to this ranking system, a rally has a way of simplifying things. Prices are up, so the former ones, stocks that were worth buying at their current price, suddenly become twos, stocks only worth buying on a pullback, because most things will have gotten too expensive. Get this? Better to keep your powder dry. Wait for a sell-off down the road before you do any more buying. Meanwhile, a lot of your threes, stocks that you wanted to sell in the strength, become fours, stocks you don't want to take any action without more information. Now, this is just a preliminary approach to what you should sell in a short-term rally. I'm going to give you more details later in the show. The reason we rank our stocks like this is to keep our emotions in check. We understand that we're frail, okay? So we buy low and we sell high instead of buying high just because it feels good at that moment. Most people, for reasons we don't have time to go into, now at least, really enjoy buying stocks, but see selling them as a defeat. But ringing the register is not a defeat when you're getting top dollar prices during a juicy rally. First, though, you have to put yourself in the sell mode, and you start doing that by getting tough on your portfolio. Bottom line, during a big up day and after, don't get swept away by euphoria, okay? Don't listen to the buy and hold doctrine that says it's not worth it if you actually want to buy it. Just book a little profit on some merchandise, because the whole point of owning stocks is that you're supposed to sell them when they go higher to make money. If the fundamentals aren't changed, if the company hasn't improved, then it might have gotten too expensive as a stock because of the rally. So when the market's roaring, give your stocks a hard time, please. Hold them to a higher standard and ring the darn register on some of the stuff, both of the names you like the least, and of course, even the ones that are up the most. Mad Money's back after the break.
Coming up, want to preserve those profits after a big rally? Cramer's revealing the next chapter of his playbook and how to build the most important part of every investor's portfolio. Next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.